Welcome back to Higgins Capital. I'm Ray Higgins. Summertime is over. Labor Day weekend is behind us. Now we've got the sprint to the end of the year. What we'll typically see for the trends between now and then are September usually is the worst month for stocks. October, we usually see the annual lows for the year. Then we see a break and a move upward into the Santa Claus rally in December. It'll be interesting times. In this video, I'm going to share with you Bob Farrell's 10 rules for investing. Now, Bob Farrell is a legendary Wall Street figure. He was the chief investment strategist at Merrill Lynch when Merrill Lynch was the premier firm on Wall Street. These 10 rules are worth their weight in gold. Rule number 1. Markets and individual stocks tend to revert to the mean over time. When markets or individual stocks get overextended one way or another, either up or down, they tend to revert to their long-term average trend. This applies to both buy and hold strategies and trading strategies. Have a plan, trade the plan. Rule number 2, excesses in one direction will lead to excesses in the opposite direction. This rule means that markets that overshoot on the upside or in one direction will also tend to overshoot on the downside. It's like a pendulum that swings to one extreme in one direction, reversing and swinging to the other extreme in the other direction. The further it swings to one side, the further it swings to the other side. Rule number 3, there's nothing new on Wall Street. Excesses are never permanent. There's usually a group of hot stocks that come along every few years. What we have seen most recently is the mega cap big tech that have outperformed the market in a spectacular fashion. We call these the Magnificent Seven. Over the years, we've seen frenzies in automobiles, railroads, airplanes. These sectors were the big tech of their day. So the corollary to there's nothing new on Wall Street is hearing the phrase, this time is different, because this time is never different. There's nothing new on Wall Street. And big tech will eventually be replaced by another group of hot stocks. But they do not correct by going sideways. They correct by either going dramatically down or springing back and going dramatically up. Rule number 5, the public buys the most at the top and the least at the bottom. The average individual investor is the most bullish at market tops and the most bearish at market bottoms. This means that many individual investors miss out on performance one way or another, either at the top of the market by not getting out, or the bottom of the market for getting out prematurely. Rule number 6, fear and greed are stronger than any plan you might have. Don't let emotions cloud your decisions. Have a plan, trade that plan. You can help to counteract fear and greed by preparing for different scenarios and understanding how the markets work and how the individual securities or sectors that you're trading are affected by factors outside of your control. Bob Farrell's rule number 7, markets are strongest when they're broad and they're weakest when they are narrow. We mentioned the Magnificent Seven, the 7 mega cap stocks. They have been driving the markets for quite some time now. If you take a look at the S&P 500 stocks, the Magnificent Seven have outperformed the other 493 stocks to a significant degree. This is an extremely narrow market. It should be raising red flags. Market breadth, having a broad market, is very important. A rally on narrow breadth, like we've had recently, indicates limited participation and raises the possibility of a sell-off. The Magnificent Seven have led this market for a long time, and eventually their day will end. That day is coming. That day always comes, without exception. Bear markets have three stages: a sharp down, a market rebound, a bear market rally, and then a long drawn-out fundamental downtrend. This has been a spectacular year for the indexes. Once again, the indexes have been carried by the Magnificent Seven. In spite of the power of the Magnificent Seven, the indexes are still below their highs of 2021, 2022. Don't get swept away by the Wall Street narrative. This looks like a bear market to us. Rule number 9, when all the experts agree on the same thing, something else is going to happen. When everyone on Wall Street is saying the same thing, usually something different happens, and it's usually in the opposite direction. Excessive bullish sentiment should be viewed as a warning flag. When good news is good news and bad news is good news, then investors should think about selling. This is a contrarian investment strategy, but it usually pays off for patient investors. Rule number 10. Bull markets are a lot more fun than bear markets. Wall Street and Main Street are much more in tune with bull markets than they are with bear markets. This is one of the reasons why it's so difficult to get a sell recommendation out of Wall Street, even in the worst bear markets. The orientation is toward bull markets or the next bull market and the need to continue buying. But what happens when you're in a bear market and every day or every week the markets are going lower? This is when you should be on the sidelines and waiting patiently for the opportunity to buy real value. And of course, this is with the understanding that there is no one out there that can pick the market top or pick the market bottom. So have a plan, trade the plan. So let's recap Bob Farrell's 10 rules of investing. Number 1, markets tend to revert to the mean over time. Number 2, excesses in one direction will lead to excesses in the opposite direction. Number 3, there's nothing new on Wall Street. Excesses are never permanent. Number 4, rapidly rising or falling markets usually go further than you think, but they do not correct by going sideways. Number 5, the public buys the most at the top and the least at the bottom. Number 6, fear and greed are stronger than whatever plan you might have. Number 7, markets are strongest when they are broad and weakest when they are narrow, as we have today. Number 8, bear markets have 3 stages: a sharp down, a bear market rally, and then a prolonged downtrend, which is exceptionally painful. Number 9, when all the experts agree on one thing, something else is going to happen, usually in the opposite direction. And number 10, bull markets are more fun than bear markets.